All right. Well, welcome everybody. Welcome to our 19th video podcast episode. In today's episode, we're going to discuss the fixed income portfolios, the impact the rise of interest rates have had on bonds, along with the pros and cons of implementing a fixed income portfolio using mutual funds or ETFs versus even individual bonds and building bond ladders. My name is Jim Kantowski, and I'm joined as always by my colleague here, Jake Sadler. And today we also have a guest that's joined us, my old friend from a previous life, Mr. Eric Stein, with East Bay Investment Solutions, and we're extremely excited to have a new voice on the show today. So welcome, Eric.
Welcome, Eric. Appreciate it.
Yeah. So Eric has a BS in finance from Indiana University. He's also a CFA. Chartered financial analyst. He was with Goldman Sachs Asset Management for several years. Chief investment officer at RSM US, was where we knew each other. And he joined East Bay, I keep having trouble saying that, as a partner in 2018. So again, Eric, thank you for joining us. It's great to see you again. I'm so glad we were able to reconnect in NAPFA. And so it's good to see you.
Yeah, it was fun to see you. I didn't expect to see you in Denver, but it was nice to reconnect and just catch up on old times and see where you are today. It was a nice meeting. And I got to meet Jake as well, which was also great. So
great. Got a little insight into what that previous life was for Jim and for you too, Eric. So sharing a few stories, good to find out.
Yeah,
what that looked like.
It's always good to connect with colleagues from the old days, and that happens from time to time. If you stay in the industry, you'll run into people. So
very small world.
Eric, we're going to use your expertise here. Since you're in this every day, we've had a little bit of a crazy year with interest rates rising so significantly, and so what we thought we would do is we dive into the effect that's had on, our fixed income or bond investments. And we would just talk about how people are implementing bond portfolios and how we need to start thinking about them now as we move forward. So I don't know if you want to introduce yourself or anything like that, or if you had anything to add to, your history or anything that you wanted to share before we dive in.
Yeah, I mean, I would just say that, I've been a partner with East Bay Investment Solutions since 2018, as you said. We're essentially an outsourced CIO, so Chief Investment Officer. So we support advisors like you guys across the country that, are financial planning focused and basically say, hey, we're looking for some additional support in our investments. And they hire East Bay to do that. Like you said, we're in it all day, every day. And as an advisor, you've got a lot of other things that can fill up your plate. And we just help do some of that heavy lifting from an investment side with the, economic and investing world changing so rapidly and so meaningfully, especially in a year like this year. That's how we work, as we support advisors like you. So happy to be part of this call.
Yeah, and one of the reasons I thought it would be helpful to have you on this call is because you do work with advisors across the country. I thought it would be useful to understand how, or at least get your insight to see how other advisors are doing it. And so you have a different perspective. You're not just coming from our perspective. You have a lot of different perspectives. And so you hopefully you can, elaborate on the pros and cons of each one of these different styles that people use. So,
Sure.
So you just want to start out and just give us that quick overview of what actually a bond is?
Yeah, so I mean, the quick overview of a bond is, if you think about it, it's more like a loan, I guess, is the best analogy to think about it. So if you have a loan out there, you're a bondholder, you're essentially, lending money to a corporation or a government, and they provide a promise to pay you back your principal, along with generally some interest as well. And that's sort of how a bond works. That's sort of opposed to an equity where you have ownership shares of the company that you're buying. So that's really the main difference between, how to define a bond and really the difference between a stock.
I'm curious, again, one of the, way you describe the bonds, is carrying with it a promise, not a guarantee, but a promise that you'll get your money back with some interest along the way. I'm curious, just at the highest level, kind of what kind of risk are you taking on, if you're a bondholder?
Yeah, it really just depends. I mean, your biggest risk is that, if you're buying, if you're lending out your money, that they're not going to repay. So you think about default risk. So, a corporation may have higher default risk than a government per se, or a municipality if you're looking at muni bonds. So that's certainly a risk. There's a concept called duration, which we can get into, which is really the length and maturity of the bond. And the more duration you have, generally the more risk you're going to have as well. So that's certainly a different kind of risk, but one that's out there. And really what you find is that whether it's, the type of bond you're buying, or whether you're buying an equity or fixed income, or even how you're implementing your fixed income, what you'll hear me say a lot is there's just trade-offs. There's not a right or wrong answer. There's pros and cons, there's trade-offs. And as long as you and the investor are comfortable and know what those trade-offs are, that's really how you're going to make your own educated decision on what you want to be invested in.
And yeah, definitely that concept of duration is really, really interesting. Probably one that, if we're talking about bonds at a high level, a lot of folks aren't necessarily familiar with. But I think if you're looking at duration, trying to explain that in as simple a way as possible, would kind of term length or maturity be a pretty close proxy to what we're thinking about when it comes to duration and kind of sensitivity of the bonds to changes?
Yeah, it's really the sensitivity of a bond to changes in interest rates, and that can work in the positive and it can work in the negative. This year, we've seen it mostly work in the negative, but it can also work in the positive. So generally, the longer the duration, the greater sensitivity you have to changes in interest rates is the easiest way to explain that.
That I think is a perfect segue, explanation of duration, and segue into one of those big questions. What is just fundamentally, what's the relationship between interest rates and bond prices? I think you've kind of pointed to that, but just if you were to describe that in pretty simple terms for folks.
Yeah, so they move inversely. So if you have bond yields that are going up, you have bond prices that are going down. There's just a really inverse relationship between those two things. So if you think about that bond, you've got two components of a bond return. You've got your coupon or income return, and then you've got your price appreciation or depreciation if your bond yields go down. So those two components are really what make up the bond return. But for your original question, your bond prices move inversely with your yield.
Yeah. So I could hold on to my bond to maturity, have that promise, I'll get my money back plus some interest. But if I needed to, sell that bond before it matured, then I'm kind of taking on that interest rate risk where, depending on what rates have done, what I'm going to get if I go to sell my bond is going to be different than what I paid for it.
Well, not only that, but the price of the bond may change as well. So the bond may be at a premium or higher than what you paid for it, or at a discount or lower. So again, there's both components of that. So you have to really look at both components when you're going to buy or sell a bond to make sure, again, that you're getting fair value for what that is. And, again, our market is fairly efficient. It may not be as efficient in fixed income as it is in equities, but it's still going to be fairly efficient. And you're going to see the way pricing mechanisms work. So if you were to go, to a custodian and look at the, a few 5-year treasury bonds, for example, that were for sale, you might see a slight deviation in price, but you're generally not going to see a large deviation in price because any kind of mispricing will be, purchased pretty quickly. Those inefficiencies tend to sort of narrow out. I
think one thing that I've heard, kind of a lot in recent years is there seems to be a great deal more transparency on the bond market, today than maybe there was 20 years ago. Is that a pretty fair statement, kind of contributing to the efficiency and effectiveness of pricing in the bond market now?
Yeah, there's definitely more transparency. Certainly the technology has improved. The way bonds are bought and sold has changed over the years. So there's certainly more transparency in these markets than there ever was before. But you also have to remember, too, there are lots of bonds. I mean, if you look at some of the indices that are out there, whether they're muni bond indices or corporate bond indices, there are thousands upon thousands of bonds in these indices, and they don't all trade on a daily basis. So, it's always interesting to see how these things fluctuate and move just because, again, there's so many thousands of bonds. If you're a corporation, let's say you're ExxonMobil, for example, you may have, again, hundreds or thousands of bonds out there. You just don't have one bond. You have different bonds at different maturities that were created at different times for different reasons. Those are all out there in the marketplace potentially at the same time.
Yep. It seems like it's a perpetual shock to folks. I'll stop. I'm just like getting excited about bonds. As Eric's talking, one of the things that seems to kind of be a surprise to a lot of folks is the bond market globally is bigger than the global equity market. And I don't know if that comes as a surprise to folks that you talk to as well, Eric.
Yeah, it's also pretty large outside of the U.S. as well. So, I think most bond investors will focus on the U.S. interest rate and interest rate curves, in terms, the yield curve as we would refer to it. But there's a whole host of bonds that are outside the U.S. and there are opportunities for value add there as well. Whether it's, in sovereign debt or corporate debt, whether it's in developed countries or emerging market countries, there's potential there as well. Again, all with their own risks and trade-offs.
Yeah, it's a little bit overwhelming when you start to put it in those certain terms. Let's go back to the risk piece of things for just 1 second. There wasn't a whole lot of default risk this year. I mean, did you see any activity where bonds were defaulting at all?
Yeah, default risk, I'll say on the the credit side, the corporate side has been fairly low this year, and default risk on the muni side has historically been even lower. So the positive news is that default risk has not been an issue this year. That doesn't mean it won't be an issue next year or the year after that, but that's something you have to look out for. And if you think about bonds have different ratings. So your AAA is your most secure. You've got AA, single A, and triple B, which make up what we would refer to as investment grade. And then anything below triple B, double B or single B or even in the C's are all considered below investment grade or high yield bonds. So you're going to see a different level of default risk depending upon which sort of tranche and credit rating you're looking at. So again, it really just depends on what type of bond you're looking at, whether it's a municipal bond or a corporate bond, and then what kind of credit quality it has. And each of those different tranches will have different levels of credit default risk, if you will, or expectations of credit default risk.
Yeah, and the real risk that I guess we saw manifest itself this year was the interest rate risk, and it was fairly significant. Do you have any? I don't know how you want to do this, or if you can, but put that in perspective for us. What happened this year in terms of the significant rise in interest rate and how it affected bonds?
Yeah, well, I think the first thing I would say is that it's been the worst year for bonds in history. We've never seen a year of bond returns as worse as we've seen this year. So let's put it in historical perspective. This has been an outlier, like no other outlier we've ever seen, which is saying something. We've been through a lot of different types of markets, equities and fixed income, but this year in fixed income has really been like no other. And really to start with this year, to talk about this year, before we talked about this year, we really have to go back a couple of years to kind of tell the story of where we've been. So if you think about, where we were, let's go back to March of 2020. We all remember COVID. We remember the lockdown environments that we were in, the uncertainty of what was going to come next. And essentially what happened was, we had to inject a ton of stimulus, the Fed did, into our economy because we were literally shut down.
Yeah.
So if you go back to March of 2020, the Fed lowered interest rates twice, actually, in March of 2020 to near zero levels, which, again, is not something we expect to see very often. So, again, we were at a place where the economy was shut down, interest rates were very low, and we had to inject a lot of stimulus. Well, let's move out of COVID a little bit. And we could argue that the Fed didn't remove the stimulus fast enough, and that we started to see bits of inflation sort of come about. And if we move back to again 2021-ish, we'll call it, the Fed looked at inflation and said, okay, well, it's transitory was the term they used, or temporary for us lay people, and we're not really worried about inflation getting to a very high level. Well, we can all, I think, all agree at this point that both of those concepts were wrong, that it wasn't transitory, and they did get higher than they expected. So in order to remove inflation, or at least try and lower inflation from where we were going in its trajectory, the Fed really only has one blunt tool to use, one instrument, and that's the Fed funds rate. And really why they wanted to adjust inflation downwards is inflation can become a self-fulfilling prophecy. So if, the easiest way to explain that's a self-fulfilling prophecy is if I'm going to go out and buy a car today and that car is worth, let's say, $30,000, but I know in 6 months that car is going to be, I'm going to have to pay $35,000 for that car. I'm going to go buy it today. I'd rather pay $30,000 rather than $35,000 because I'm in an inflationary environment. And if everybody does that with everything they're buying, you wind up spiraling inflation in an upward trajectory, and it sort of gets out of control. So the Fed obviously did not want that and needed to reduce inflation. And again, the only instrument they really have to do that is through interest rate adjustments. So go back to the beginning of this year. They started in March with a small 25 basis point increase in the Fed's fund rate. That really didn't do much. Fast forward to May of 2022, they increased it by 50 basis points. Didn't really do much. In the last 4 meetings, which has been unprecedented, they've actually raised Fed funds rate by 75 basis points in each of the last 4 meetings. And we have our next meeting coming up in mid-December this week, and it's expected right now that the Fed will increase by another 50 basis points. So we just have these massive and consistent increases in Fed funds rate, interest rates on the short end of the yield curve, again, with the sole goal of driving down inflation. Because again, I'll go back to the Fed. The Fed has 2 mandates. One of their mandates is full employment. So we have very low unemployment right now, which is great, almost too low. And their other mandate is stable prices, which with high inflation, we don't have stable prices. So they're doing everything they can with what's in their power, which is, again, raising the Fed fund rate to try and reduce inflation. The hard part is it's a pretty blunt instrument that they're using, and it comes with a tremendous lag. And we don't know what that lag is going to be because they can institute the Fed fund rate and raise it, but we don't really see the impact in the economy. It could be 3 months later, it could be 6 months later, it could be 12 to 18 months later. We don't really know. So they're continuing to watch data, but at the same time, they've been continuing to increase interest rates at the same time. The risk is that they raise them too high, too fast, and we run into a recession. I'd say the worst risk is that they don't increase them high enough, fast enough, and we get really high inflation like we did in the 70s. So they're really trying to thread the needle there and balance those 2 components.
Yeah, it's a really, really tough to balance the whole. And so we've had this significant increase in interest rates like you just described. And, that goes back to what you talked about. The question Jake asked about earlier was this duration concept. And so those rise in interest rates drove down the prices of bonds. And we've seen this, I guess, negative impact on our portfolios.
Yeah, and what's interesting is, if you think about the concept of duration, it assumes sort of a equal rise in rates across the curve at the same time. The reality is that almost never happens because, the Fed, when they're raising interest rates, they control sort of that short-term part of the curve. But the markets, the investors and expectations sort of control the rest of the curve. So if you looked at the curve today, you'd actually see a fairly flat curve towards the end of the curve, the 10 to 30-year part. And you'll actually see an inverted curve where the front end of the curve, the 3-month, the 6-month part of the curve is actually higher than the longer part of the curve. We call that an inverted yield curve. Because again, in normal expectations, you'd expect to receive more interest over a longer period of time than over a shorter period of time, which is again, not what we're seeing today. The challenge with an inverted yield curve is it's correlated with recessions. So if you look back at a lot of the periods in the history where we've had a inverted yield curve, we've actually seen a recession come. An inverted yield curve doesn't cause a recession, it's just correlated with a recession.
Is there any degree of timing, in that correlation, Eric, where you can say, okay, we've got an inverted yield curve, we're going to have a recession in 6 months, or is that, pretty random?
Yeah, it's pretty random. I don't have the data in front of me, but if you look back at the last several times we've seen an inverted yield curve in a recession that's followed, there have been a variety of different time periods where that recession has come. So there's no way to look at it and say, okay, here's the time period we should expect, because it really just depends. And, again, the Fed doesn't really want to cause a recession. They're not purposefully going out to try and force a recession, but they do want to lower interest rate or lower inflation, which means an increase to interest rates.
Yeah, Jake, as we go down have this conversation, there's so many questions that are starting to come out. So it's hard for us to control ourselves.
Rather humble.
Yeah. So I'm like,
Tim's like, stop asking questions.
No, I'm starting to spin. I got questions.
I know,
because we talk about these interest rates, but Eric brought up a great point. It's like that's not the only thing that's affecting these bond prices. I mean, the markets are efficient, and a lot of times these changes in interest rates are priced in beforehand, and and there's other data involved in the pricing mechanism. So it's not always as simple as, hey, the interest rates are rising, the bond prices are rising. There's other factors, I guess, is what's starting to come to mind, or I'm being reminded of.
Yeah. And keep in mind too, we're talking, Jim, about just the U.S. Treasury curve.
Yeah.
If you looked at the U.S. corporate curve, that's going to have a different shape than the Treasury curve. The U.S. muni curve is going to have a different shape. And then we talked about non-U.S. curves. Each of those different countries is also going to have their completely different shape, driven by their own economics, their own governments, their own central banks. Each of those components are going to cause those curves to shift and change for different reasons at different times. So that's why, from our perspective, we look at a lot of investors and say, okay, if you only have U.S. interest rate risk, possibly moving into something outside the U.S., something to at least think about, something to possibly consider. Again, it has its own set of risks, including currency risk that you can hedge out, but it's at least something to consider.
So, oh man, I'm stumbling here on this, but so there's so many factors that need to be taken into consideration is what you're saying here. And so, like, if we think about that in terms of how we're implementing investment portfolios, we're typically using mutual funds and ETFs, and those investment products have been hit pretty hard in terms of negative performance on our statements. And so people are starting to ask the question, well, hey, should I be taking a different approach? Should I be building a bond ladder? Should I be having my own individual bond portfolios? But so maybe you could just take a stab at helping us understand how those ETFs and mutual funds have been affected by this swing, and then just the differences in the
infected by higher interest rates.
The difference in the laddering and in the individual bond portfolio when you're implementing somebody's investment strategy.
Yeah, and I think the hard part with the mutual funds and ETFs on the fixed income spaces, they've been impacted in different ways for different reasons. So again, it somewhat depends on whether you're looking at a short-term fund, an intermediate-term fund, or long-term fund, because they're going to be driven differently by interest rates. And it also depends on whether it's a government, a corporate, or usually looking at a more core broad with agencies and mortgage-backed securities and other types of investments in it. So it's really going to depend on what the duration of the fund is or ETF is. It's also going to depend on what the holdings are. Generally, this year, what we've seen is that shorter-term funds have gone down less than some of their longer-term counterparts. And again, that goes back to the duration. And we've also seen, in many cases, sort of treasuries outperform corporates just because of the risk of sort of corporates that, corporates are riskier than treasuries generally. So that's why we've seen sort of corporates underperform treasuries this year. So that's going to be part of it. But again, there's all sorts of different types of funds out there. It would be impossible for me to categorize all of them in one sort of simple sentence. But it really goes down to, what is the purpose of fixed income for your investors, and what are they trying to achieve with that purpose? And can you show them sort of how what they're doing from a fixed income perspective is still sort of working? Again, we've had sort of that negative price depreciation this year from the rise in interest rates, but now we also have coupons that are actually fairly attractive. We have yields that are fairly attractive in these bonds. So if you look at the 3-month treasury, the beginning of the year, it was 8 basis points. It's now over 4.3% as of last night, or as of Friday night. So you can just see the dramatic change in interest rates. So where if you're a retiree, if you're a saver, and last year and the year before that, you're basically not getting much of any income at all on your fixed income investments. Now sitting in a money market fund, you can get 3.5% ish, I'll call it. In a short-term fund, you can get 4-ish. There are attractive yields to be had in fixed income now that didn't really exist before. So again, it's sort of short-term pain. Nobody likes to see their fixed income go down like we did this year in these funds. But going forward, you should actually expect to see a better return just simply because of where yields are today versus where they were a year ago today.
I think, Eric, one question that I kind of see around and occasionally get is, okay, worst year on record for bonds. Okay, we're kind of setting the table for where we are now. Has anything fundamentally changed? I mean, you talk about purpose and using bonds in the portfolio, and we think a lot of times about the volatility dampening effects of including bonds along with a mix of stocks or equities in the portfolio. I mean, has anything fundamentally changed in the relationship that we see between stocks and bonds, or at least in terms of how bonds can be used to dampen volatility? This year, it hasn't really felt like that's been there, but are bonds still, give us a realistic chance of dampening some volatility moving forward?
Yeah, we still expect to see bonds be a dampening tool for stocks over the long term. Again, not every year is going to be exactly the same, but we're going to expect that going forward. Kind of what we saw this year was the correlation or the movement between stocks and bonds actually move in the same direction, which hasn't really happened over the last decade or so. You expect bonds and stocks oftentimes to move in opposite directions, and this year we saw them move very much in line with one another. So if we can get sort of that diversification benefit of stocks and bonds going forward, that would again be positive for fixed income investors in particular.
So with these different products that we're using, can you just compare that to what a ladder might look like, and just maybe define what a ladder is, a fixed income ladder is, and then compare how investing in that might be a little bit different than a mutual fund or ETF?
Yeah, so a ladder in its simplest terms, if you think about just sort of the step ladder you have in your house, you've got different rungs of the ladder. So if you think about a bond portfolio, what you do is let's say we're going to buy a 10-year ladder. You buy a security that is a bond that's going to mature in 1 year, another one that's going to mature in 2 years, another one that matures in 3 years, all the way out to 10 years. So if you have $1 million, you split it up, at a tenth to each different rung of the ladder, and you buy out that ladder. So essentially, each of those bonds will mature, assuming no default, and you take that reinvestment of the bond and you put it at the end of the ladder. So your bond matures in a year, you buy another 10-year bond with that $100,000, if you're again assuming $1 million, and you just sort of rinse and repeat that cycle. That's the way it works. It's really great for an investor that wants to own individual bonds or has specific coupon or income needs, where you could say, okay, based upon where we are today, we can map out the next 10 years and say, here's exactly what you're going to get in terms of income. Here's exactly when these bonds are going to mature. And it's very helpful for those kind of clients that want to see their bonds mature and want to see their income. Again, assuming no default risk, it's a very easy thing to set up, and it's very attractive from that income standpoint. The challenges are, if you are only buying treasuries, you're giving up potentially income from corporates, which should have higher yield than treasuries over time. And if you bought sort of a corporate ladder, it's very, very difficult to diversify. So you really only, if you're only buying 10 bonds, you're buying sort of 10 companies, and your risk of default just becomes greater, just because, again, you're only buying 10 different companies, and you're not able to diversify as much by different sectors, different types of bonds, and different companies. So that becomes a little bit of a challenge. But again, it's a relatively inexpensive way to do it, and it's relatively clean from that perspective. If you compare that to a mutual fund or an ETF, you've got hundreds, potentially thousands of bonds in those vehicles. It's more of a pooled vehicle where you're buying a share of a bond or with other investors. But the downside of it is you can actually be impacted by what other investors in the fund do. So let's say you own a large fund, you own part of a large fund. lots of investors decide to sell their share for whatever reason, and the portfolio manager has to raise cash in order to give them back their redemption amount. They may have to sell some bonds they may not want to sell, or sell them at prices they don't want to sell them at in order to get that cash redemption. That can have a negative impact on you, the investor, whereas you don't necessarily have that same issue in a ladder. The plus side is they're much more diversified. You can do lots of different things in them. You can buy corporates, you can buy treasuries, you can buy securitized bonds, you can buy agency bonds. It's much easier to buy bonds outside the U.S. Again, it's just much more diversification. There's not as much customization, or really no customization, in the mutual fund or ETF space. And then we could talk too. I mean, we can go down a completely different rabbit hole and talk about active management and passive management of mutual funds and ETFs. You certainly run the risk of an active manager making poor decisions as much as you have the potential benefit of an active manager making good decisions for fixed income. So again, it's just sort of, there's lots of different varieties out there of ways to attack fixed income. There's no one right or wrong answers for every client, but for the most part, it becomes a set of trade-offs that you have to find out for your specific client what makes the most sense for them.
Go ahead, Jake. You got something.
I mean, I'm feeling off.
I can hear it.
I do. One question I had on, I think you're speaking a lot, Eric, to different ways we can diversify our bond holdings, whether it's, by issuer, by credit quality, by term length, all these, buying, U.S. government versus, foreign sovereign government debt, all these different ways to diversify. I think a couple questions on ETFs and mutual funds. I mean, number one, are they a pretty effective, low-cost way to diversify across all these different aspects for diversification, on the bond side? And then question number two, I really like that term rinse and repeat. If you're building a bond ladder for yourself, so bond matures, you go ahead and buy, fill up the next rung on the ladder. Do ETFs and mutual funds kind of take a rinse and repeat approach to buy into ever higher interest rates that are available, say in a rising rate environment?
Well, that's actually a really good point, Jake. So if you think about that bond ladder, one of the big risks of a bond ladder is that in a rising rate environment like we've been in, you may not be able to participate in those higher rates as fast as you would in a mutual fund or an ETF. So for example, let's use that same example where I'm buying a 10 rung ladder. If I were to purchase that ladder last year where interest rates were really low, that's what I'm set for the next 10 years until I start having some of those bonds mature in year 1, year 2, year 3, and then I can go out and buy that. In a mutual fund where they're constantly buying new funds, assuming that they have consistent contributions into their fund, you're going to be able to buy bonds at a higher yield and faster. You're going to have more bonds maturing faster, be able to reinvest at a higher rate in a faster way. So you might be able to take advantage of those higher rates quickly, more quickly than you would necessarily in a intermediate to longer term ladder. So that's a really good point. The diversification benefit, mutual funds and ETFs are a great way to get exposure to vast majority of bonds, large parts of the market very cheaply and efficiently. It really goes down to, the cost kind of comes down to what kind of manager you can have. Like anything else in the equity land, you can find a low cost manager, you can find a high cost manager. We would tell you can generally find a very good low cost manager that would do a good job. And, especially when rates are low, a high cost manager has to outperform by so much in order just to make up their fee. So they might have to take more risk. They might have to do different things in order to make up their fee differential. We don't necessarily think that's worth it and would really focus on a lower cost manager that can achieve a lot of the same things.
Yeah, I love that. And can you essentially also build a ladder with ETFs and mutual funds? So we could hold some short-term mutual funds or ETFs in a portfolio with some longer-term mutual funds and ETFs in a portfolio. Is that a similar concept? Do you see people do that?
We can certainly buy short-term, intermediate-term, or long-term funds and ETFs, but you could also actually find ETFs. There are firms out there, I don't necessarily name names, but there are firms out there where you can actually buy ETFs that are laddered ETFs. So you can buy a 2023 ETF ladder rung, a 2024 ETF ladder rung, there'll be more diversification in them than they would be in individual bonds, but you're not getting away from the component where you're not actually owning the underlying security themselves. And those underlying bonds may change that are in those ETFs. So again, it's a little bit of a hybrid between both, but it's not as clean as owning the actual individual bonds themselves.
Jake, what I'm hearing is this is extremely complicated, and there's lots to think through when you're implementing these portfolios, and it's keeping you in business.
There's a lot to stay attuned to, and I think, Eric, one of the first things you said, I think just points to our role. As advisors, we're kind of generalists in a lot of ways. We just can't ever get enough resources, especially on the investment side, to just get more perspective on things. So I really appreciate all the perspective you shared today.
Yeah,
absolutely. I hope it was helpful for you.
Yeah, I go into these every week, Eric, thinking that there's no way we're going to be able to talk about this topic for 30 minutes. And then here we are in like 36 minutes, and there's just a ton more questions we'd love to ask. So really appreciate your time. Again, so great to reconnect, and we'll talk about equities at a later date.
I'd love to be invited back and join you both again. So thank you for your time, and I'd love to help out on any other topics that are investment related. That's what we do all day, every day, and we kind of find it fun. I know it's weird to a lot of people, but that's what we enjoy.
I'm like, a big grin talking about bonds. It's been fun.
Yeah, I tell people, taxes are fun.
Yeah. We haven't seen fixed income at Stein in a long time, so it's kind of fun to talk about bonds again.
Yeah, awesome. All right, well, there's more to dive into, so maybe we'll have you back on bonds, stocks, and all kinds of different topics. So again, thank you for your time, and enjoy the holiday season, and good luck in 2023.